we asked the Treasury and the bank, where on earth does the government get the money from that it spends on a daily basis? And unfortunately, they weren't prepared to tell us. They always came back saying it was out with public interest. It was obvious from the sense that the government started with zero balances. If it's starting with zero balances, what on earth is it spending? Where does the money come from? It became obvious to us that it had to operate on intraday credit. And then the DMA, or the Debt Management Office, via the debt management account, would do its magic work, smoke and mirrors, and bring the accounts back to zero by the end of the day.
This is the MMT Podcast with Patricia and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. For as little as $1 a month, you can get early access to all our episodes and patron-only episodes. A big thank you to all our supporters so far. At the beginning there, you heard richardntye, who, along with our two other guests this week, Neil Wilson and Andrew Berkeley, have produced a groundbreaking new study that details the internal accounting operations of the UK Exchequer and the ultimate impact of government spending and taxing on the private sector. This is part 2 of a 2-part conversation, and part 1 is our last but one episode. That's episode 84, so do skip back and have a listen to that if you haven't already. If you're new to MMT, you might want to listen to our first 3 episodes where me and Patricia talk through the basics, but if you want to dive in here, the headline is that a government that issues its own currency can't run out of that currency, and therefore austerity is as pointless and dangerous as the politicians that push it. For currency issuing governments, such as those of the UK, the US, Japan, Canada and Australia, the money story starts with a government that's been given a mandate to do certain things, to create and maintain infrastructure. That might mean building schools and hospitals and paying teachers and nurses, or it might mean building border walls and prisons and paying consultants to come up with reasons to not pay teachers and nurses. But whatever's been decided, the problem for government is how to mobilise people and resources to achieve those things. And the solution that governments use today with our modern money systems is taxation. The purpose of taxation is not for the government to get money to be able to spend, but to get money to be worth something in the first place. The government lays on a tax in something it alone is allowed to create. In the UK, we call that something the British pound, and this creates people needing to earn the government's unique tokens in order to pay their tax bills. So the government can then spend its money into existence and hire those people to build a space force or print blue passports or whatever else a sophisticated government needs to do to provision itself. So given there's no shortage of money for the issuer of it, what then causes money to come into existence? As Richard, Neil and Andrew's paper shows, the money that the UK government spends to achieve their policy goals is essentially voted into existence when Parliament passes legislation to achieve those goals. Why is this important? Well, Kurt Vonnegut once wrote that he thought that novels that leave out technology misrepresent life as badly as Victorians misrepresented life by leaving out sex. And in a similar way, I think that economic coverage that leaves out the reality of how governments spend serve humanity as badly as Fred and Mary Trump did by not leaving out sex. In our so-called advanced economies, where people are dying because of an unwillingness to change a few numbers on a spreadsheet, the government's infinite capacity to spend its own currency isn't the end of the story, but it needs to be the end of the austerity story as soon as possible. A few notes before we dive in. In the conversation, you'll hear us talk about tally sticks, and there's more about the history of those in our episode 53 with Professor L. Randall Wray and our episode 45 with Professor Steve Keen. You'll hear Andrew mention some interesting papers put out by the Bank of England in the 1960s and 80s, and you'll also hear that the authors are happy to get constructive feedback about the paper, and contact details for them, along with links to everything else I just mentioned, are in the show notes. where, as ever, I've linked to where you can support this podcast financially via patreon.com/MMT podcast. Support starts at $1 a month, which is 73 British pence at the time of recording. And no matter what level of support you give, you get early access to all our episodes and patron-only episodes where you can ask me and Patricia MMT questions. We are 100% listener supported. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. So thanks as ever for the time you put into understanding MMT. Let's dive in. Let's move on to the Ways and Means account. When does the Ways and Means account, or is it the Ways and Means fund, when does that get used?
The Ways and Means account, yes. Okay, there's a bunch of policy rules within government that says that all the accounts must hit zero at the end of the day. That's just a set of terms and references that the that Treasury has put out there. It's not. There's nothing hard and fast about it. It's just a government policy. And the other government policies of the Debt Management Office has to offset these zero accounts. And the Ways and Means account these days comes into play when the Debt Management Office either chooses to or fails to offset the balances. And so it's essentially an overnight overdraft. That's what the Ways and Means account is. Everything ends up there unless the Debt Management Office does something in the meantime to stop it from happening. So it's automatic that it goes there. Throughout the day, everything runs overdraft. That's how they all work. They all start the day at zero. So if they start the day at zero and you spend first before you get anything in, it'll go overdrawn. They don't care about that because of, and again, there's another piece in the, Exchequer and Audit Department Act, 1866, that essentially tells the Bank of England, thou shalt treat all government accounts as though it's one account. And so they can't actually charge overdraft fees on anything that runs overdraft because there'll be something else somewhere else that'll be offsetting it at the Bank of England. Just an overdraft.
Richard, is it worth saying anything about where the Ways and Means account came from? Because it's the story of Gladstone.
It is. I think it is, and that's. I think it might be an open question. But if we, and it is in the paper in one of the appendices, I forget which. But it comes with the evolution of the consolidated fund and how government spending operationally occurred. In terms of if there were requirements for advances on the fund. So if it was deficient in any way in terms of funds, it would get an advance from the bank. Now, in the old days, it would essentially issue Exchequer bills. That would be the asset upon which the Bank of England would then issue the liabilities for the government to then spend. And the way the fund worked was that, and you can still see it today, so there are standing services and supply services. In the old days, they were consolidated fund services, and I think they were supply services have always been as that. So consolidated fund services were payments that were permanently authorised by Parliament, essentially. And standing services came in whenever there was a surplus on consolidated fund services, essentially. And its evolution is quite difficult to describe. Essentially, as we evolved through the system, the government realised that it was quite expensive issuing. It felt it was expensive issuing Exchequer bills to the bank for advances. And so Gladstone decided that he would negotiate with the bank such that the government would no longer issue Exchequer bills to the bank for its advances. What would happen is that they would both be accounted for as book debt. And we believe that book debt is the origin of the Ways and Means account. Now, I can't find any definitive evidence for that, but that's my belief based on what we've found. So you run through the system to the present day, the Ways and Means account's still there, and effectively it's just booked as debt between the two entities.
It's a very peculiar name, isn't it? I mean, is it?
Well, that derives from the way Ways and Means were a certain type of taxation that was permitted by Parliament to fund basically government departments. So it goes right back to the history of it. So Ways and Means effectively were just taxes, essentially.
In that Exchequer and Audit Department Act 1866, which I think was the sort of the culmination of Gladstone's efforts, there was a provision in there that talked about advances being provided by the Bank of England to the Exchequer on a quarterly basis. So there was a requirement for like a quarterly accounting period over which accounts would be made, advances would be made, but advances also paid back over that quarterly cycle. These advances being enumerated as a book debt now, just like a record of the debt, as opposed to, an actual Exchequer bill being passed over or whatever. And then if you fast forward in time, I mean, the first reference I've found to the Ways and Means account, I think, was maybe during World War One, or something like that. So I guess we are joining those dots together as a hypothesis, at least. But then you fast forward a little bit further. In 1946, the bank was nationalised, and then in 1952, I don't know, or is it 1954? I think the Finance Act abolishes this requirement for a quarterly accounting period to be associated with the advances that the bank gives. And then what you see through the 1950s and 1960s is the Ways and Means account being used as like a daily balancing item, a daily balancing mechanism to balance the flows of money between what the Exchequer is doing and what the Bank of England wants in terms of managing the banking sector. So instead of it being a quarterly accounting period over which the advances are kind of accounted for, it becomes more like a daily or weekly thing. The Exchequer may have an overnight overdraft, or it might have an overdraft that persists for a few days or maybe a week or so. If that just happens to be how the Exchequer's flows and the bank's monetary policy operations have kind of balanced out, so you've got this balancing item, this overdraft that acts as a balancing item. Remember, at this point in time, the bank is managing the Exchequer's flows and the Exchequer's debt and cash alongside its own monetary policy operations. So the Ways and Means account became, at least by that point, just like a daily or weekly balancing item that would bring the banking sector into balance according to how the Bank of England saw it. Then if you move into like the 1990s, you actually saw that the Ways and Means account was really persistent. I think there was something, 15 to 20 billion on the Ways and Means account. And now the Ways and Means account is formally part of the issue department of the Bank of England. And so that 15 or 20 billion balance on the Ways and Means account that was there by the 1990s as a persistent balance was essentially a type of government security backing the bank's issuance of banknotes. At that point, you then have the Bank of England independence, the change to the Debt Management Office, and a new policy adopted, not a law, but a policy adopted to say we'll try not to use the Ways and Means account. And so by that point, what you had was, instead of it being a quarterly period over which the bank would advance money and then the Exchequer would sell gilts or treasury bills to essentially move that debt out into the private sector, instead of it being a quarterly period or a weekly or daily accounting period over which that would happen from the 50s and 60s and 70s, it became a daily cycle. So now what you have, instead of the Ways and Means account being used, you have the bank advancing money to the Exchequer during the day and obviously taking on a counterpart book debt as an asset. But by the end of the day, if the Debt Management Office has done its job, all of that debt, or all of that advance that the bank has made to the Exchequer has been converted into treasury bills or gilts that are held by other people in the economy instead of the Bank of England.
This was very difficult to get to the bottom of. We asked the Treasury and the bank, where on earth does the government get the money from that it spends on a daily basis? And unfortunately, they weren't prepared to tell us. They always came back saying it was out with public interest. But it just became obvious to us that it had to work on
how is it out of public interest?
You ask them. I don't know. I would have thought there's nothing more of public interest than that, of how the government actually spends. But it was obvious from the sense that the government started with zero balances. If it's starting with zero balances, what on earth is it spending? Where does the money come from? And so it became obvious to us that it had to operate on intraday credit. And then the DMA, or the Debt Management Office, via the debt management account, would do its magic work, smoke and mirrors, and bring the accounts back to zero by the end of the day. Although they won't tell us.
It's obvious from those articles in the 1960s and 1980s that that's what happened. I mean, it's clear in those. Yeah. So if that's not what's happening now, you have to ask what's changed, and there's no indication that anything's changed. Like you say, the accounts start from zero every day, but they nevertheless make payments. There is a bit of legislation that's arisen out of Brexit that explicitly authorises the bank to extend intraday credit to the government. The bank extends intraday credit to all the other banks within the sterling monetary framework. So there's no reason why you should expect it not to do the same for the government. The bank has, in freedom of information requests, used sort of quite cryptic language to say things like, the money doesn't come from us; it comes from Parliament, and all we do is facilitate the payments. But I mean, that's what a bank does, isn't it?
Yeah.
So if you have a zero balance and you ask your bank to pay something, it can still pay it for you. It can still facilitate the payment. And it just means that you end up in debt, and that's exactly what happens with the government.
Back in April, the government approved extension of the Ways and Means facility, and that made headlines, and everybody said, "Oh, printing money." And you say in your paper that they've actually haven't used the facility since they approved it.
They won't do, Patricia, because it was smoke and mirrors. the Ways and Means account was always there. That is the default option. The reason why they said that in April is, oh, by the way, don't forget we've got the used Ways and Means account, was because interest rates were climbing on 3-month bills. If you look on the interest rates for April the 9th, 2020, after that announcement, you'll find that the interest rate on 3-month bills collapses. And the reason is because basically they're going to say, we won't sell any more of these if you don't start playing the game. We know what you're playing and we're not having it. So there was a very coded message to the banking sector that if you want some free money, you better start playing the game, otherwise we'll take it away. So it was a warning to the banking sector that they will take the punch ball away if they don't play. The DMO has no reason to issue bonds to the private sector unless it can get the rate that it wants, and it was very clearly. In that wonderful coded language that they like to try and play. We're still playing the game, we're still pretending that we're doing the circus, but if you don't play with us, then we're going to stop. I hadn't quite got to the bottom of why they'd said that, because it made no sense to me as to why they'd said it. Because I thought, well, the Ways and Means account's always there and everybody knows it. So why have they said it like that? And it took a little bit of digging. And it's only actually when I was working with Richard and Andrew and I was looking through the 3-month and 6-month and 12-month Treasury bills to find out what was going off. I thought, hello. And you could see it clear as day. It was starting to tick up towards April the 9th and then thump, dropped straight off a cliff. And now they're starting to talk about negative interest rates. And they talk about negative interest rates and sending forms out saying, can you let us know whether you can do negative interest rates? And the 3-month and 6-month bills have gone negative, you see. So it's expectation management.
It's useful to think about what it would have looked like if they had just used the Ways and Means account. So what would have happened is the government would have been spending this, 200 or 300 extra billion into the economy. That would have realised itself as new central bank reserves. And on the other side of the bank's balance sheet, as a counterpart to these newly issued central bank reserves, you'd have had a book debt, a record of a debt to the government. or a debt of the government to the Bank of England. So the Bank of England's balance sheet would be massively inflated with both new central bank reserves and new debt to the government. But what's actually happened? Well, what's actually happened is the government did spend all of that money. It did arise as central bank reserves in the first instance, as all spending does, by virtue of, the Exchequer and Audit Departments Act 1866 that we've talked about. But then the DMO did sell the treasury bills or the gilts every day to drain that back out again. But of course, the bank was doing its own operations this whole time, and we've just had more of that this week. So the point that we're at now, after 9 months of this or something, the banks, I don't know if we still call them quantitative easing operations or asset purchases or whatever. What we've got are a massively inflated central bank balance sheet where the additional funding that the government has made over this period is expressed as central bank reserves with a corresponding government debt on the other side of the central bank's balance sheet. It's just so happens that it's gilts rather than a ways and means account record, but it amounts to the same thing. So we've got to the same point. We've just had, I guess, an intermediary, which is the bond market, but it all ends up at the same place. So I mean, I suppose you have to ask, why bother? And I don't know. There's a bunch of different answers you could provide to that question, I think, but who knows?
In your paper, you also mention about the development of the bond repo market in the 1990s. Is there any difference in the way that we issue bonds now to the way that we issued bonds, say, during the war?
Well, yeah, there is. I mean, there's the gilt repo market didn't really exist before the mid-1990s in that sense. It used to be the case back in the very, very early 1990s and prior to that if you wanted to get hold of any gilts, you went to National Savings and you bought them. And so they were effectively sold over the counter. You could also buy them directly from the Bank of England as well if you were in the banking sector and were like that. Gilts were constructed in the 1980s. For example, index-linked gilts are only constructed to allow final salary pensions to cover their liabilities. There's no other purpose for them to exist. And this idea that private sector pensions are private sector pensions is a bit daft, actually, because quite a lot of their liabilities is covered by government debt, which means that we pay for them. They're effectively government pensions by the back door that they put a big label over it and charge a fee for. There's quite a lot of the government liability, quite a lot of pension liabilities are covered by gilts. And that's actually the reason for issuing gilts. The reason for issuing gilts is to cover pension funds and insurance companies off. That's their reason, raison d'etre, if you like. And that's, if you think about it from the history, that's what the debt was issued for. They were issued as annuities to people to receive an income.
We're establishing that the Parliament is the source of money. Money is voted into existence. We're converging on that conclusion. There's a little ripple in the story when it comes to national insurance. When MMTers want to start telling people, the government creates new money when it spends, somebody will pop up and say, but what about national insurance? The national NI receipts are paid into the NI fund and state pensions are paid out of that fund. So how might we answer the critic who might say, so taxes do fund spending in the case of national insurance?
Look at the 2015 National Insurance Fund account. What you'll find there is what's known as a Treasury grant to the National Insurance Fund because it was short. There you go.
Is it unusual for it to be short, or does that happen often? Not
particularly. I think it's happened a few times over the last decade or so, hasn't it, Andrew?
I think it's usually in surplus, but yeah. When we say a surplus, though, there's certainly some misconceptions that I've heard from people about the National Insurance Fund. It's a hypothecated tax because it's collected for a particular reason and it only goes to spend on certain things. In most cases, taxes just go into the ether, and all spending comes from the same place. But a hypothecated tax would be revenue from a particular tax that is earmarked for a specific form of expenditure. And I think a lot of people believe the national insurance to be that type of tax. It's spent on unemployment benefits, other forms of social security benefits, and the NHS. And when we pay it, we therefore think that's what it's going to. Or at least some people do, I think. The other misconception that I've heard is that it's kind of pre-funded. You know, there's this big war chest of funds that's already been accumulated, and that's sufficient to pay out, you know, the state pension for X numbers of years or something. So I've paid into that, so I get my pension out of that. That's the other sort of misconception that I think you often hear. Turns out not to be the case at all. The National Insurance Fund does have an asset. It does have a you know, a form of wealth, if you like. You look at its balance sheet. It's got a big balance. It's got a big bank balance. But that bank balance is just internal to the Exchequer. It's a balance. It's a balance in what's known as the debt management account deposit facility. So the debt management account is acting like an internal bank. It receives deposits from the National Insurance Fund, and then it chucks the money straight back into the banking sector, because that's what the debt management account does. You know, the whole point of the debt management account is if money comes in, it has to send it back out to the banking sector, because the whole design of the Exchequer is to keep the banking sector balanced, to keep the banking sector neutral, or to keep the banking sector at the same state that it was in at the start of the day. So that's the role of the debt management account. And so when the National Insurance Fund has surplus receipts coming in on a given day, it gives the money to the debt management account. The debt management account throws it back out into the banking sector. It doesn't hold on to it, but it records a deposit for the National Insurance Fund. Now, the National Insurance Fund has a number recorded in the debt management account that is its number, its asset, its bank balance. But it's all completely internal to government, completely internal to the Exchequer. It's not money that you and I would recognise as money. Now, what happens next is when the National Insurance Fund wants to spend that money, it can draw that money out of the debt management account. But the debt management account doesn't have any money, you would say. It's already sent it back into the banking system. So where does it get it from? Well, by virtue of the National Loans Act 1968, any deposit or any borrowing that the debt management account does has recourse to the consolidated fund ultimately. So essentially what that deposit is in the debt management account is a claim on the consolidated fund. And once you've got a claim on the consolidated fund, you've got a direct link through legislation, the Exchequer and Audit Departments Act 1866, to an order to the bank to make an issue of money. So now the National Insurance Fund can withdraw that money from the debt management account and make a claim directly on the consolidated fund to make a state pension benefit payment or another type of payment. And in that sense, it's just arising in the exact same way from the consolidated fund as every other expenditure. A bit like the contingencies fund, you've got this internal song and dance that makes it look very complicated and perhaps gives a misleading impression to folk who are on the outside of the Exchequer. But actually, when you look at the accounting, the expenditure just arises from the consolidated fund in the same way as other spending.
It seems all smoke and mirrors. Is there any good reason to do it in this way, hypothecated, or is this just a political ploy, basically?
If you look at the National Insurance Fund accounts, there is actually, and also the reports that are put into the National Insurance Fund. The reason for doing it is so that Parliament is forced to reconsider what the social security benefits are on an annual basis. That's one of the reasons that they state forward there, is that this process that they have to go to forces Parliament to consider whether the state pension is sufficiently covered by parliamentary authority. So rather than it just being swept under the carpet, the whole process is put in front of parliamentarians, and they have to actually authorise the increase in expenditure on an annual basis. So that's how they justify it. Although whether that's just the auditor talking his book or not, I don't know. As in, because if we didn't need that, we wouldn't need his services either. So there's a little bit of this where with these things, whether they're saying this because otherwise I'd be out of a job is not really a good justification. But no, there is a serious point there of it's done like that to try and make it visible, so that it doesn't get forgotten about. It's too often in this country the state pension gets swept under the carpet.
I should say there's a piece missing from what I just described, in that what I just described shows how when the National Insurance Fund has a positive balance, it stores that in the debt management account, and then it can withdraw that from the debt management account and effectively have a claim on the consolidated fund from which it can make an expenditure. But that implies that it needs to have a positive balance, but it doesn't. And this is what Neil started off saying earlier, that if HM Treasury or HMRC believes that the balance on the National Insurance Fund is insufficient at any point in time, they can request money to be drawn explicitly out of the consolidated fund for the purpose of providing a balance. So in that sense, you can see how any expenditure from the National Insurance Fund could simply just arise directly from the consolidated fund in the same way that any other funding is made. And that's the reference Neil made to like 2015. I think that might have been the last time that was done. So in the supply and appropriation process, where each department is allocated its annual expenditure, HMRC can be provided an allowance for the simple purpose of building a balance or increasing the balance on the National Insurance Fund. So yeah, I think that just completes the story and shows how any of the spending that comes out of the National Insurance Fund really just comes from the consolidated fund.
Now let's talk about how the government's bank, the Bank of England, interfaces with you and me, the private sector. Patricia had a question to get us started on how that works.
Oh, yeah. Can you explain a little bit about the government banking service, what it is, and also describe the relationship it has with commercial banks? Are the accounts of commercial banks mirrored within the government banking service? How does this work exactly?
It took a lot to unpick, and it required reading about the Paymaster General and how the Paymaster General operated. So there's a lovely book called The History of the Bank of England and its Services to the State, and it was written by, I think, an Austrian, a chap called Eugen von Filipovich, and he wrote a book. He wrote this in 1911. He wrote an entire history of the Bank of England, and towards the end of the book, he, in one section, he talks about the Paymaster General. And he talks about its history, and he talks about it being the account from which all government spending is drawn. And then, of course, you're thinking, well, all government departments have bank accounts. Surely that's where the money is. Well, it's not. The money is in the Bank of England. And government departments had ledger accounts at the Paymaster General, essentially. Wind forward, that system was amended in 2008 when the government banking service was brought in. The office of the Paymaster General was abolished. The Paymaster General's accounts and the Paymaster General was moved into HMRC. And then they contracted commercial banking partners to come in and run the transmission services for those accounts, for government department accounts. But effectively, the Paymaster General's accounts still exist at the Bank of England. We don't know their names. We don't think they've changed from as they have been for the last 150, 170 years, or whatever it might be. So the Paymaster General's office was established first in 1836. It was then various other paymaster offices were amalgamated by another Act of Parliament in 1848. And that system operated all the way through until 2008.
At this particular point, most payments are done in the UK and in general really through a system called BACS, which is where essentially how everybody gets their salary. And there are 3 grades of BACS. There's BAC grade 1, which is basically punter grade. That's us. That's when we get to pay our bills and everything through BACS. We use grade 1. There's grade 2, which is how the banks pay each other. And then there's grade 3, which is how government does its payments. And the way that works is that it uses the functions of the BAC system to use what's called a nostro account, which is essentially a account where the money is. And it's a perfectly common, very ancient way of the way banks are done. Banking is done. And you have the account within the actual bank itself. So in this case, it would be, if we're making a payment, it'll be NatWest, who manage the numbers on the individual account for the government department they're talking about. But when they make the payment, the actual money comes out of the Nostro account, which is at the Bank of England, and you specifically enter that into the BACS fields on the record, and call it a Grade 3 payment. So a Grade 3 payment is a classic what's called correspondent banking transaction, where the accounts are managed within the bank, but the actual payments come from a bank that's outside that bank. And anybody who's done any sort of foreign exchange transactions at the banking level would recognize it. It's a classic correspondent bank. If I want to pay dollars, I can't pay dollars in the United Kingdom. I have to ring up my counterparty in the United States and ask them to pay dollars. And that's essentially what BACS Grade 3 does within the United Kingdom system, is that the NatWest is essentially managing the sort of Exchequer money, and it asks the Bank of England to pay sterling to the account that's actually receiving it.
Just to make it real for punters, punter grade. I love that.
Punter grade, yeah.
Punter grade. Just talk us through that commercial bank to commercial bank transaction. So let's say, Patricia wants to pay me £5.
So if you're paying between different banks,
yeah.
If you're paying between different banks, then what will happen is that the bank will mark down your account by £10, and it'll mark down its account at the Bank of England. So that's the NatWest account at the Bank of England.
I hate to be a stickler, but it's £5.
All right, okay, £5. Sorry. Have you not heard of fees?
I just didn't want to confuse any of the listeners. Oh, right. So if they need to pay £5, they've got to pay £10.
You've got to pay £10. The bank, they always rob you. Okay, so sorry, you get £5, and that's marked down in your account, and they mark down the bank's own account at the Bank of England by £5. Then the Bank of England account at the bank that you're going to is marked up by £5, and there's an instruction that essentially goes across to that bank to mark up Patricia's account by £5, and then she goes on the beers.
Well, in London, that's a half. She's in Islington as well. It's like the London of London.
I told you we're a tenner. You see, this is the trouble.
Yeah, exactly. You were right all along.
So, whereas with government, of course, then it's different. Is that they mark down the account within the record, but the account isn't the bank's own bank reserves. It's the Paymaster General's account at the Bank of England that they mark up there. And we found this by looking at the terms and conditions of bank accounts.
She's the only person that's ever read them.
We read these things so you don't have to.
Oh my word.
There was a wonderful line in there that said that if you wanted to use BACS Grade 3, you had to supply the details of the account at the Office of the Paymaster General from which the money will be debited. So we had it cast iron in a Lloyds Bank terms and conditions statement that's actually how it worked. So we know that's for certain is how it works, because obviously Lloyds would never lie.
Now, I've been paid by people. I've done work for people, and in front of me, they've paid me, and I've had it in my bank account in the evening, right? After business hours. And that happens instantaneously. Now, the payment is not officially cleared and done until the reserves move, as I understand it. I'm confused as to how it can instantaneously appear, how my balance gets marked down and hers gets marked up in pretty much instantaneously.
Well, the way that they do that is that the banks pre-position transfer money with each other under the faster payment system. It didn't used to work like that. Not until a few years ago when they introduced the faster payment system. If you press go on your banking app, it'd be 3 days later before it turned up.
Yeah, I remember that. It wasn't that long ago.
Unless you paid them 20 quid for a CHAPS payment. Now, a CHAPS payment is literally them instructing the reserve system to pay immediately, because what's called the real-time gross settlement system at the Bank of England is what actually settles the reserves, and that happens in real time. That's why it's called real-time gross settlement. It's clues in the name. And the transactions there are settled immediately, and that's always settled in a final form in Bank of England reserves straight away. when you're using the faster payment system, which is for smaller amounts, what happens is the banks essentially pre-position an amount of money up front that effectively the Bank of England can clear down to wherever it's going to at that particular point in time. So it's sort of a hack on the top of the back system, if I recall. Getting the actual details of exactly how it works is difficult, and it was after my time. I didn't implement any faster payment stuff. I wasn't in banking at that point, so I'm not 100% clear on how it works. But it's this pre-positioning process. So when you say £10, it docks a bit off of that, transfers it across to the other side, and marks it up almost straight away. And then they kind of sort out the differences after.
They worry about the reserves later.
Yeah.
Before the faster payment system, you would have had to take in £10 out in cash and then give it to me.
That would have been faster, yeah.
Incidentally, of course, you've always got to remember that a £10 note isn't money. It's a receipt for money at the issue department of the Bank of England. So when you are holding a £10 note, you do actually have a deposit at the Bank of England. So we can hold deposits at the Bank of England, but only in note form at the moment.
I think about notes as this is like a physical manifestation of a part of the reserve balance.
It's just a receipt. It's all it is. But it's also a
portion of a tally stick.
Let's say back to tally. It's a promissory note, isn't it? That's right. It's a promissory note, not a bill of exchange. We get very technical at this point.
I guess the implication of this, one possible implication of this is, I think previously, before government banking service was established in 2008, the Bank of England actually provided what would be called retail banking services. So if you've got a government department like the Department of Health and Social Care, checking its own bank balance online or whatever, somebody has to provide that service. Somebody has to provide the transmission services that allows it to execute payments. And that was the Paymaster General, I think, using essentially the retail service infrastructure provided by the Bank of England. And the Bank of England said that they were going to withdraw from providing retail services. So the Exchequer had to find an alternative, and the alternative was decided to be the commercial banking sector. But I guess, interestingly, what they could have done, I suppose, and this is what some people argue did happen wrongly, was what they could have done is they could have gone completely into the commercial banking sector. So that their receipts, the Exchequer's receipts, the tax revenue and other things just sit in a commercial bank account, and spending comes out of that commercial bank account. That could be what they chose to do at that point, and it is what some people claim did happen, but it's not correct. What actually happens is that the money, if you want to call it that, still always sits at the Bank of England. So when a payment is settled between two banks, like Neil just described, you have these central bank deposits that the banks hold that are being transferred between one another. Well, in the case of government banking service, it's accounts at the Bank of England that the Exchequer holds that provides that settlement underneath. Although the Department of Health and Social Care, for example, may log on to their bank account and see that it's a NatWest bank account, it's not NatWest that are settling those transactions when they're made. The money, the central bank money that is being used to settle those transactions into, a nurse's bank account for a salary, which might be held at, say, Barclays or HSBC. Those reserves are coming from the Bank of England and held by the Paymaster General or the Government Banking Service account. They're not coming from NatWest, which is the Government Banking Service commercial partner. So in a sense, what the Government Banking Service commercial partners like NatWest are providing are kind of the retail banking services, but not the underlying settlement of payments. That's still coming, as it always did, from the Paymaster General Government Banking Service accounts held within the Exchequer at the Bank of England. So you conclude from that the government isn't really using the commercial banking system in the same way that we do. It's kind of using it as a veil or as a front end, as a dashboard or something like that. But underneath, the flows of money that actually settle these payments are still arising from the Bank of England in the way that they always have done, and in the way that we've described in some detail earlier.
And you mentioned that there are 3 banks that are at the moment hold contracts with the government to carry out these transactions. You mentioned NatWest is for supply of payments. Mm-hmm. Is it Barclays for taxation?
Barclays currently do HMRC's dirty work for them, yeah.
And Citibank.
They did do HMRC's work, but they lost the contract on the last round, and I think they currently manage foreign exchange transactions on behalf of the government now.
Has it always been like that, Richard?
So if you go pre the government banking service, my understanding is that HMRC had private contracts and used commercial banking partners to do its work, whereas the paymaster used the Bank of England. So the retail side of the paymaster was from the Bank of England.
There's a bit in the paper where you talk about the reason they split it up three ways is...
It's relatively straightforward, is that if the government does all its banking through a bank, that becomes the central bank. The actual function of the central bank of flowing the money backwards and forwards is it becomes the central bank. And things, I think Andrew and I did a sort of we gained moving the consolidated fund to one of the banks, didn't we? And tried to flow it backwards and forwards that way, and to try and see what would happen. And very quickly, I think we moved it to HSBC, and very quickly HSBC's liabilities become very important in the economy. At that point, it gains an advantage over the other banks. So the reason they split it up in that way is to try and stop the banks becoming too systemically important in that way.
So let's now talk about monetary policy. And so this involves the government telling its bank, the Bank of England, to target, say, a 2% rate of inflation. Then the Bank of England use their independence, quote unquote, to do that thing that the government told it to do by deciding on a short-term interest rate. And in order to hit that target interest rate, that's where this thing the literature calls cash management comes in. We talked about that earlier. Now, I've heard Warren Mosler say that what the Fed does all day is a thing called offsetting operating factors. Now, does that fit with what you discovered about the Bank of England's operations, at least until 2000? I know that things changed in 2000.
Yeah, I mean, those articles that I talked about earlier from the 1960s explain it just so clearly. It talked about bankers' balances. So that's the aggregate reserve balances or the aggregate position that the banks have with respect to the Bank of England on any given day. And they have a targeted, the banking sector has an aggregate target that they or did have in those days that they would seek to reach by the end of any given day. And the Bank of England would try and keep them short of the reserve balances that they wanted by selling treasury bills, so that if they're short, then they have to come to the bank to borrow. In that way, they can borrow reserves from the bank at the bank's own bank rate. And that's how the sort of implementation of bank rate would work, by keeping the banks short of the balances that they want. And then alleviating that shortage at bank rate. The Exchequer's flows, whether it's a daily surplus or a daily deficit, depending on the expenditure and the taxation, would simply feed into the picture on the banker's balances side. So the bankers may be left short because they've paid a lot of tax over to the Exchequer, or the bankers may be in excess because the government's made a lot of payments that day. But essentially, all of that would simply feed into the operational arithmetic that the Bank of England would be considering. There's also other flows in and out of this system. There's advances that the bank might make to the banks quite independently of these things. There's also foreign exchange flows. There were things called tax reserve certificates in those days. So there was a bunch of different reasons why the balances of the bankers would vary on a day-to-day basis. And the Exchequer's flows would be one reason, not the only reason. And quite apart from that, the bankers' own targeted balances may change, or the Bank of England may have a change in monetary policy that they want to exercise. So there's a lot of moving parts, and the Exchequer's flows would be one of those moving parts, probably the largest single factor, but only one of a bunch of different moving parts. But crucially, the Bank of England would be seeking to kind of offset all of those different flows to produce the right effect on the banker's balances, as it would describe it. And essentially, that's what the debt management officer's role today, like I said earlier, part of what the bank used to do has been delegated to the debt management office. So now the debt management office just has to offset just one part of that system, and the part of that system that they have to offset is the Exchequer's flows. So whether the government's in deficit that day or in surplus that day, the debt management officer's job is to offset those flows in either direction to produce a neutral effect on the banker's balances. And once that's done, the Bank of England can then go about doing its own tweaks to the system as it sees, without having to deal with the Exchequer's flows explicitly.
And this offsetting, just what it would look like in the real world. Are we talking about one person or several people just buying and selling government securities on the secondary market? Is that what it amounts to?
Yeah, that's exactly what it is. It's the DMO spends usually first thing in the morning. It tries to be price taker. People effectively turn up at the DMO saying we're going to need so much money today because we've got payments to make, or we've got this money that we're going to have spare, so we'd like to buy some gilts and treasuries. And yeah, they have approved counterparties that they have in the actual money markets who the debt management office trade with on a daily basis. One of the things we show in the paper is that the gilt auctions are largely superfluous to the entire operation. The DMO does cash management on a daily basis. It effectively pulls gilts out of national loan funds whenever it needs it and puts it into the market as required to drain whatever excess money it's put in there. And then the gilt auctions are essentially just a swapping process with those gilts over time.
And these trades that are happening all day, how many trades do you think happen in a day of that nature?
It's a huge amount. I think there's I don't know if it mentioned. Does it mention it in the debt management office annual review? I can't recall them mentioning how much they place on a daily basis. But they show a little graph that shows you what the position is of the Exchequer on a daily basis, and then how they offset it. And you see the large flows that occur. For example, when gilts are redeemed, you'll see these large flows, and then they'll show you another line that shows how the DMO effectively offsets that by doing more repos. So there's a little graph, I think it's chart 12 in the annual review, that explains that. I can't remember what the magnitude of it is, but it shows essentially that DMO spends most of its time underwater, as in it's mostly got more gilts out in the market than the money drawn back in. And those are effectively rectified when the gilt auctions come about. The repos come off and the gilts are issued in the gilt auctions. But that's just kind of a gilt for gilt swap. The money for gilt swap is a daily operation with the DMO.
I just think one thing that adds to the confusion about what money is and what the national debt is and all that is that this thing that we're calling cash management is done by the debt management office using the debt management account. And I don't know if you agree with this. Is it fair to say that what the DMO are doing all day, they're changing the ratio of interest-bearing pounds to non-interest-bearing pounds through all of these operations in order to hit their interest rate target? But because they're doing this by buying and selling government debt instruments, they're called the debt management office. And for you and I, the goal of managing our debt would be to eliminate our debt and avoid insolvency. And therefore, the people who don't get how these debt instruments are used to hit a target interest rate, they think, oh, look, the government has a debt and they're trying to manage it and they must be failing because there's a perpetual government debt. Therefore, how can you propose any new spending? We're in debt. They're completely missing the point that these debt instruments are just ultra safe, interest-bearing financial assets for the private sector.
We really shouldn't call it the debt management office. We should call it the deposit management office, because that's what it's doing. It's managing the different deposits at different rates. So that's what it's doing. It's saying, right, you've got a 0.1% deposit. I'll swap you up for a 2% deposit if you'll leave it on deposit with me for 3.5 months or whatever. And that's essentially what the debt management office does. It actually, the DMO manages the deposits with the private sectors, with the various people, and just change it up and down. What they're trying to do is get rid of all these bank reserves, that are excess bank reserves in the market, so that then they can leave the Bank of England on the other side to change it as they see fit. It's just when you aggregate them together, you'll see that you get what you're describing there. If you put both the DMO and the Bank of England together, then you get that change in gilts and money reserves. But really, the money reserve amount is handled by the Bank of England. So when that wants to change the amount, that's what QE is. QE changes the amount of bank reserves in the system, and the debt management office actually changes the types of gilts. So it might be gilts and treasury bills. So it's 3 months, 6 months, 9 months, 1 year, 2 year, 5 year money. Depending on what quite literally depending on what the money market asks them for. That's actually how it works. They sit down and they talk about it and say, well, what do you need this month? Right, okay, well, we'll issue those then. That's how close the relationship is.
There's a phrase that is notoriously missing from your paper, and that is printing money. Everybody tells me that QE is printing money, and I'm trying to see from the paper at what point, how do you differentiate what is printing money from non-printed money, and why one would be more inflationary than the other? Is there a history, a background to this phrase? Was it ever relevant, or is it completely a political made-up?
I think last time when Neil was being interviewed by Phil, you were saying, when they showed that thing of the printing presses, what's actually being depicted there is an asset swap.
Yeah, well, that's what they all are. I mean, gilts to reserves to cash. Cash is 0%, reserves is 0.1%, and gilts is a bit more depending on what your maturity levels are. So it's just it's just a question of where do you want to move up and down the stack. That you've cash at the bottom, then you've got reserves, then you've got the treasury bills, then you've got the gilts, and all that does is just change the maturity profiles. That's all. One's overnight, one's instant bearer bond. That's all they're doing is they're just changing the various different types of monetary instruments, and that's how it's been throughout history. You go through them, and just people negotiating how long do you want my money for, and how much are you going to give me for it, and it's just doing the same thing, and people panic about it. It's like, but this has been running like this for centuries, and it's worked perfectly okay. So what are you worried about?
Tell us what a repo is and what a reverse repo is and why they're used by the Bank of England. Right.
So a repo is a repurchase agreement, and that's what it stands for. And what that means is that you buy an instrument from somebody, and at the same time you have a contract to sell it back to them at some point in the future for an amount of money. And that's what the Debt Management Office uses on a daily basis. If it wants to drain money from the system, then what it will do is it will buy gilts, where it will buy gilts on a repo arrangement, which means that it will buy the gilts from the market, and it will put a contract in place to sell those gilts back at some point in the future. And the way that's accounted for is it comes across like it's a loan. It isn't, but that's how it's accounted for. So it looks like it's a loan. Now, what I've just described there is actually technically a reverse repo because I'm doing it from the DMO's point of view. I have to get these the right way around, otherwise I'll look like an idiot. When you provide money into the market, you're doing the reverse repo bit. And when you're providing the thing, you're doing the repo bit, I think. If I've got that the wrong way around, I'm going to get text messages by the bucket load, but never mind, that's the way it goes. So when you talk about a repo and a reverse repo, it just depends on which side of the transaction you're sat at. Are you supplying the money or are you supplying the thing initially? And obviously that will then reverse when you sell it back in the future. And that's how DMO does cash management. It does these repos, and it does them for all various different terms. I think it mentioned 19 days in the future or something like that. I think it mentioned in the annual review, and it just lines the cash up so that it knows it's going to get these things in, because the flows that go in and out of the treasury are relatively predictable in terms of how much payments it's going to make. What it doesn't know is how much tax it's going to get in on a daily basis. That's the bit that throws the calculations out, because that depends whether anybody actually does the transfer to the HMRC or not. And so the cash flow management is done on that basis. So yeah, they'll just it's just a swap. That's all it is over a period of time.
Okay. I wanted to just pull out some juicy bits from the paper that you wrote regarding the issue of government solvency, where money comes from. It's the last paragraph of page 115 nails it for me. Quote, "The consolidated fund has no deposit with any other body, and the apparent negative equity is the reflection of the provision of a net money supply to the private sector. Implicitly, the consolidated fund does hold a sui generis balancing asset." Could somebody just say what sui generis means and why that's important in this context?
Sui generis just means of its own type, not like anything else. It's a classic legal term. But yeah, that just means something that's not like anything else.
Okay. Though this sui generis balancing asset is never formally enumerated, as the consolidated fund does not prepare a balance sheet, in the whole of government accounts, it is described as liabilities to be funded by future revenues. Since this asset precisely balances the equity held by individuals, it follows that those private sector equity balances can also be described as assets to become future government revenues. In other words, the net financial equity of individuals is merely that which the Exchequer has issued and not yet taxed out of circulation. It also follows that reducing the value of this sui generis asset by pursuing policies of debt and deficit reduction via increasing taxation or reducing spending correspondingly reduces, all other things being equal, the quantity of government securities in issue, and which necessarily means reducing the private sector's net financial wealth. This conclusion is completely independent of whether the Bank of England is considered as part of the public sector or otherwise. So, mic drop at that point, right? But can you tell us now about these two different ways of consolidating the accounts? You could analyse it with the Bank of England being part of the government, which, given everything we've said, it's obvious that it is. Or you could do an analysis where the BOE is a private sector entity. What utility is there in thinking of it as a private sector entity?
It very much depends what you're wanting to focus upon. If you wanted to focus upon how the Bank of England interfaces with the commercial banking sector, then you would consolidate. You would draw the line underneath the Bank of England and put the Bank of England into the public sector, and then you could be able to analyse. Well, this is the classic MMT line. We analyse the movement of reserves. You know, the classic Warren Mosel line of that you can't do a reserve drain until you've done a reserve add. We can show all that very easily from that consolidation. If you want to look at it the other way around, and you want to look at the Treasury's interface with the Bank of England, then you would consolidate it the other way down, which is what we do with the system of national accounts. That's actually how the national accounts are drawn up. The national accounts are drawn up with the Bank of England in the private sector, because they want to look at the flows between Treasury and the Bank of England. The thing is when you actually put those two side by side and you analyse them side by side, the actual flows through don't change depending on what the consolidation is. It doesn't make any difference which way you do that. All it does is it highlights different things, just shines the torch on a different part of the process. So it very much depends what you're wanting to analyse. As MMT people, of course, we consolidate the Bank of England into the public sector because we want to analyse the reserve process. That's how we draw it out. And what we call net financial assets, what we say in the paper is net financial wealth. MMT people call it net financial assets. Is this sui generis asset that's held at the consolidated fund? As far as the UK is concerned, that's how it is. They literally balance each other out. MMT's net financial assets are the net financial liabilities that are held by the consolidated fund as an asset.
Regarding tax, the paper shows that the tax flows into the Government Banking Service HMRC accounts at Barclays and then is transferred to the Government Banking Service HMRC accounts at the Bank of England several times a day, and that tax must by law be paid into the consolidated fund. So given that tax revenue flows into the consolidated fund and the consolidated fund is the source of moneyness, how is that not a case of tax revenue funding spending?
Quite simple. What happens if the tax revenue is insufficient, which it typically is? That shows you everything you need to know. Now, what it also shows is the fact that those two things are being equated somewhat simply shows that taxes offset the spending in the same way that the debt management office's activities do. There's a bunch of different roles for tax, but the role of providing funds for the government to spend is not one of them. One role for taxation, when you look at it in the very, very simple daily accounting that we've described, is offsetting the spending. So the spending goes out, the tax comes in, and to a large extent, that spending will have been offset in the sense that its effect on the banking sector has been offset. To the extent that it hasn't been fully offset, that's when the Debt Management Office has a task to do. So the Debt Management Office is the sort of balancing act, the balancing item. Its activities are the balancing item on the Exchequer's activities. But tax does the most of the job. That's the main reason for tax, like from this sort of accounting perspective. It's not providing the funds that go out in the first place. If the tax doesn't come in, that does not mean the spending can't go out. But when the spending does go out, the tax provides a good deal of the offsetting of the effects of that spending on the banking sector, and the Debt Management Office can mop up the rest. And if tax is greater than spending on a particular day, the Debt Management Office can send that excess surplus receipts back into the banking sector through a reverse type of operation. So
is the right way of saying it, I'm going to give it a go, basically saying that the government has infinite capacity to offset the effect of a consolidated fund deficit into the banking sector.
infinite capacity to offset. I don't know.
The effect on the banking sector of any imbalance between taxes and spending, basically.
I don't think it really has much difficulty in offsetting its activities. So if its activities are a large spend, then some of that will be offset by the tax that flows in. But let's imagine that the tax doesn't do enough in that sense on that particular day. Then it's the debt management officer's job to offset the rest. That means sell some gilts into the market to drain out the reserves that have been created by the excess spending. Has the debt management office got an infinite capacity to do that? I wouldn't go that far, but I don't think that that it has the problems that are often purported, such as the bond vigilantes. Who's going to buy the government debt? Who's going to think that the government's creditworthy? Blah blah blah. We explained earlier on, and the Bank of England explained in the 1960s that in fact the banks act as the residual buyers of the bills and gilts because they're already sitting with the excess reserves. So to that extent, the debt management officer's task is pretty easy. It's got a captive audience in a sense. Does that mean it's got an infinite capacity? Well, if there's a big crisis like the pandemic, like the global financial crisis, when the investors, the people that would typically buy the bills or the gilts are kind of acting irrationally or whatever, and it's not quite sure what's happening. Yeah, you could imagine there might be a scenario where the debt management office doesn't get its job done. But well, what happens then? The Ways and Means account. The Ways and Means account is just an automatic implication of that type of scenario. The spending has already gone out. The intraday credit has already been advanced by the government to the Exchequer. It's already happened. It just gets registered as a Ways and Means account entry at the close of business.
Explodes.
Don't think so. No.
It's just credits and debits, Patricia. That's all it is.
Yeah.
Just making sure.
The credits will always match the debits.
So the government can't run out of money. Let's go back to the early history of the bank, Richard. Tell us about the National Debt Reduction Act of 1786 and the commissioners for the reduction of the national debt. I'm thinking these guys are the original deficit trolls.
Yes. So the commissioners for the reduction of the national debt was set up during, as you said, 1786, and a drive again to attempt to pay down national debt. That had already happened back in Robert Walpole's time with the first sinking funds in around about 1720. And what they would do is they would take surpluses from all the other various funds that they had in the Exchequer and use those to pay down some of the debt that they'd issued. Invariably, it failed, as it would fail, because they needed money all the time. And so Parliament would basically requisition and appropriate that money and spend it, generally for purposes of war. And again, that happened with the sinking fund that was set up in 1786. But the commissioners are still around. They still exist, and they manage government funds today, one of which is the National Insurance Investment Fund. They run Crown Estates Fund and also the National Lottery Fund as well. They've been in commission for about 220, 230 years odd, and they're still going strong. And they work currently at the DMO.
The National Lottery is a crime, right? It's just, isn't it?
Well, it's just taxation.
You know its name, don't you? The prole tax.
Yeah.
It's just a form of taxation. And that's how, they've had lotteries for hundreds of years. There's nothing different. You could go back and have the Exchequer just issue tally sticks, and it would function exactly as it does today.
Does that mean we get to burn down the Houses of Parliament again?
Oh, yes. Yeah, absolutely. The tally sticks were first, I think, around about that time that we're talking about, where there was a push for reform in the system. So from about 1780 onwards, I think an Act of Parliament was passed to abandon the tally stick system, but it didn't kick in until I think about 1825 or 1826, when the last people in the office keeled over. And then I think a few years later, they decided they had too many of these sticks hanging around, so they put them in the furnaces under the Palace of Westminster, lit them, and the entire palace burned down.
Which is why we have the Parliament that we have.
Yeah.
They had to rebuild it in that model, you see. So it's all, everything's down to tally sticks. Even the existence of the current Houses of Parliament is down to that.
That's what I always wondered, because the Houses of Parliament are done in the Gothic style, but they don't belong to the Gothic era. So they were like, it was a throwback to the past.
Yes. Yeah, the Victorians were very fond of that.
Yeah. Interesting.
Do any of you have anything that we feel like we haven't covered yet?
One interesting thing to touch on, I think, is the fact that the Bank of England was just one of a set of corporations that were set up around the sort of the end of the 17th century and early 18th century. So not only do you have the incorporation of the Bank of England as a source of money for the Exchequer, but you also have the South Sea Company, you have the New East India Company, and you have the National Land Bank. And they were all set up along the same lines. The National Land Bank failed, but out of that act came Exchequer bills. And that was surreptitiously put into the bill just in case the National Land Bank failed. We just see today the Bank of England, but there were many other iterations of something similar that were used as a vehicle by the government to gain money. And
the mess that we have today is the result of various iterations of failed systems in the past.
And it's just been added on, and some have been reformed. So in terms of cash and debt management, once upon a time it was out with the Bank of England, then it was in the Bank of England, and now it's been taken out again. And it just goes back and forward, depending on which civil servants are in charge and which idea has got the sway.
From my point of view, the key point that I will want to get across, or the key point I think from an MMT point of view, is that the United Kingdom has possibly the most MMT-ready system in the world. We have intraday overdrafts. We have interday overdrafts. There is no limit on anything. The legislation is already in place that allows the Treasury to instruct the Bank of England to do whatever is required. So there is no...
There's no debt ceiling, for instance.
We've got none of that. So we're ready. We're ready and rock and rolling, ready to go. We've got a half-built job guarantee almost. It's so close to being what we require. And as is the case with the UK, all we do is alter things. So we don't need revolution. We just need to do what Britain's always been very, very good at, which is just, tweak it a bit and move it a bit that way and a little bit that way. And it'll be a higgledy-piggledy organic mess, but it'll largely work. I mean, that is our political system in a nutshell, isn't it? So, we've got a political system like that. We can have a monetary system like that, and everybody will be employed. Prices will be stable, and we can move the country forward.
Sounds like a great place to leave it. Thanks so much for your time, guys. Is there anything you'd like our listeners to do apart from read and digest and demand better governance?
It's a working paper. So comments will be welcome, and we're collating comments, but it just allows us to have a rethink and then perhaps explain things in a better way or present things in a different way. So I'd encourage listeners to, if they do have any comments, to email us, and we'll at some point put out another version of the document.
As this thing evolves, let's talk again.
Thank you, guys.
Thanks very much.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month, and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.